Hello, Stephen Cruz here with MyMortgageBroker.com and Paragon Mortgages. And today I wanted to talk about the RSP home buyer plan strategy. Now, I had done another video about the strategy, and today I want to give another case study. This is a little bit more complicated case study, but it really shows how you can take advantage of this program. So before we start, if you like the information I provide and you want to see more of my information, please press the subscribe button below and give us a little like. That really helps me out. And let me just share my screen and we can go from there. All right, so the RSP homebuyer case study. In another video, I talked a little bit about the homebuyer plan and the details, how to qualify and that sort of thing. So if you look on the top right here, you'll see a link. You can go watch that video. I've also put the video link in the description below so you can watch that as well. It gives you more details. Basically, I'll just review the first-time homebuyer plan briefly, and then talk about the case study after that. So the homebuyer plan, the key factors is that you must be a first-time homebuyer. You can withdraw up to $35,000 from your RSP without any taxes to purchase a home. And if there's two buyers, each buyer, if they're both first-time homebuyers, can withdraw up to $35,000 from their RSPs each. So that's a total of $70,000. You must pay back the money over 15 years. So you take $35,000 or whatever you take out, divide by 15, and pay that every single year. The money must be in your RSP for a minimum of 90 days, and you can make multiple withdrawals from the money. You can also take funds from your RSP up to 30 days after you move in. So if you didn't take enough, or you didn't take everything you thought you needed, and you had taken possession of your house, you have 30 days to withdraw the funds after that. So that's basically a gist of the program. If you want more details, I talk about it in that other video. So here's the client case study. And you know, it's powerful because you can increase your down payment substantially. You can get some extra money from the government, from your taxes, for basically just shuffling money around in most clients' cases. So the best time to do this is January, February, but you can do it anytime throughout the year. There's no real disadvantage, but you get the money more quickly if you do it in January, February. So that is really the best time to do it. So these clients, Eric and Libby, are purchasing a house. This is their first home. They qualify as first-time home buyers. And so one earns $90,000, the other earns $75,000. They both have more than $70,000 in combined RSP contribution room, and each of them has more than $35,000. So that's really important. That's one of the keys to make sure you have enough room, because you don't want to over-contribute to your RSP if you want to do this thing, because you're going to pay penalties when you over-contribute. So you want to check your RSP contribution room. They have about $40,000 in savings. So let's just say it's $20,000 each, but they do have $40,000 in savings, and they have saved the money in their tax-free savings account, which most people do nowadays. That's a good thing. Great that they have savings, and it's good for us for this strategy. So they want to buy a house for $500,000, and that is the price range they're looking at. And so when they met with me, I told them a little bit about this strategy and how they could take advantage of it. So what they did, and this is getting complicated, so I want to make sure that we're clear with these. So I've kind of put them in a little bit of a spreadsheet, and so you can understand and see how it goes. So each of them has $20,000 in their tax-free savings account. What I suggest they do is take out an RSP loan. And so they take out the RSP loan, they put $15,000 each into their RSP, and now they have a $15,000 debt. So you can see that in total, they have $35,000 now into their RSP. They transferred it from their tax-free savings account, and they're going to put it into their RSP, and they each have a $15,000 debt. So you can see each of them has a $15,000 debt. So they transfer the money, they still have the debt, $15,000 from tax-free savings account to RSP with the debt. Now they're going to get a tax refund. Eric makes a little bit more money, so he's in a slightly higher tax bracket. He gets a slightly more money back than Libby does. So he gets about $10,800 back. She gets $10,100 back. So they're not going to put that money in their savings account. They're just going to keep that in their bank account. So they're not going to put it in their RSP, should I say. They're just putting it in their bank account. So now they have a total of $45,000 available to them, and they each have a $15,000 debt. So they owe $30,000, but they now have 45 each. So next, what they do is they take some money out of what they have and pay off their debt. So when you're purchasing a home through the RSP program, the RSP Homebuyer Program, you can withdraw $35,000. So they withdraw 35, and they have 10,000 in their bank account. Now they've got 45 in their bank account. Then you take 15 of it to pay off the debt. So now each of them is left with $30,000. They've paid off the loans, no debt. They're debt-free just like they were before, but now they've turned their 20 grand each in savings into $30,000+. Pretty good deal. The structure here is their down payment. Their down payment's going to be $50,000. They're going to put 10% down on the purchase of their house. So $50,000 of this total is going towards their purchase. The rest, $10,000, is left over, and they can use it as a little reserve to cover some incidental costs, to put an emergency fund in, and maybe buy a couple of things for their new house. When we look at the return, $20,900 return on a $40,000 investment is a 52% return on investment, and that happens basically in 90 days. Not bad. And it's legal. This is a legal return on investment by shuffling your money around, taking advantage of some strategies like taking out a quick loan and then paying it off. The disadvantage is that they will have to repay their RSPs. Each of them pays $2,300 toward their RSP every year. They don't get a tax refund for that anymore because they already gotten their tax refund. So that works out to be about $195 a month. So that is a liability that they have. But you know what? They want to fund their RSP for the future anyway. And so that's something that they were willing to do and that they could afford to do. The other advantage that they don't think about is when you have $40,000 down on a $500,000 purchase, the CMHC, or the insurance premium, high ratio insurance premium, and I can put a link to a video that I created talking about whether or not high ratio insurance is mandatory or not. And so when you have 5% but less than 10% down, the premium is higher than if you have 10% up to 15% down. So in this case, in today's numbers, the premium with $40,000 down would have been $18,400, but because they were able to come up with $50,000 because of this little fancy strategy, the premium went down to $13,000. So that's a $4,900 savings. So not only did they make $20,000 in a tax refund to use towards their purchase and have a little extra left over, they've saved $4,900 on the mortgage as well. So these programs are really important. It's important for you to know what's available to you when you purchase a house. If they'd come to me too close to when they purchased their house and they didn't have the time to leave the money in their RSP for 90 days, they couldn't have taken advantage of this program. So it's important to learn about these programs early so that you can utilize every possible advantage you have when you buy a house, because there are programs that are designed for you to save money. And I'd much rather see the money be in your pocket than in the pocket of the government. I have some tools to help you get pre-qualified, and you can find those tools on my website, mymortgagebroker.com/calculators, or you can just go to mymortgagebroker.com and then click on calculators in the header there, and that will take you to a bunch of calculators, 3 main calculators. One helps you to figure out how much you will qualify for a mortgage based upon your income. There's another mortgage payment calculator, and there's another one that talks about a home buyer incentive, which is also available to home buyers. I'll put a link here again for a discussion about what the homebuyer incentive is and how it works, and you can see that video as well. If you like the information on my video, I talk about mortgage-related, finance-related topics in Canada please subscribe to my video, and I'll send you much more information and help you to be more informed when you are doing your financing here in Canada. And if you like this video, please press the like button. That really helps me out, and I would really appreciate it. So thank you very much for listening to my case study. You have a fantastic day, and good luck if you are a first-time home buyer. There are so many things you can take advantage of as a first-time home buyer. Have a great day.